Jason. We're going to officially kick off. First and foremost, thanks everybody for joining and welcome to our webinar today on how to configure NetSuite for intercompany transactions. We'll start with some quick introductions. My name is Scott Grillo. I'm the Services General Manager at Charted. Charted is a full-service NetSuite partner. We help companies implement, optimize, and support NetSuite. I have 15 years of NetSuite experience helping organizations evaluate the NetSuite product, plan implementations, actually implement and then support their environments long term. And I'm joined by our resident intercompany expert, Peggy Eveleth. Peggy, you want to introduce yourself?
Sure. Hi, I'm Peggy Eveleth. I've been in the NetSuite space about 8 years now. Prior to that, I did other ERP solutions. My area of specialty has always been around multi-subsidiary accounting, foreign currency accounting, intercompany issues. Prior to coming into the NetSuite space, I was a global controller, so I attack everything pretty much from an accounting perspective. And this has been an area of expertise of mine since I started my career way back when. So I've always been doing multi-subsidiary type stuff with a focus notably on international, but obviously it works for domestic subsidiaries as well.
Fantastic. Well, we've got a fun-filled agenda for everybody today. Short disclaimer, this is not going to be a high-level overview. This is not going to be a high-level sales pitch on NetSuite or NetSuite Intercompany. This webinar is for practitioners, people who want to get really into the details of how NetSuite works, how it can be configured for multi-entity, multi-subsidiary businesses. So we're going to dive deep into the details, talk about key concepts, talk about specific NetSuite features, configuration options, and we'll do that with the following agenda. We'll first define the intercompany charges. We'll talk about configuring those intercompany features. We'll talk about determining the charge types and how to treat different intercompany charge types within NetSuite specifically. And then finally, we'll address intercompany charges for foreign entities. We're going to be doing live Q&A. So as you have questions, put them in the chat. We'll answer them as quickly as possible in real time. Ultimately, you ask, we'll answer. And with that being said, let's get into the details. Peggy, I'll hand it over to you.
Okay. So, as promised on the agenda, what is an intercompany charge? I just wanted to talk about this really briefly because it's good to be on the same wavelength. So a transaction, intercompany charge is a transaction that one entity creates on behalf of the other entity where both entities have a shared ownership. So what does that mean in English? It means that company A and company B are related because they are owned by the same parent company, or at least owned in majority by the same parent company, and they are doing transactions with each other. So the transaction can be either balance sheet based or income statement based. So balance sheet based, company A lends company B money. Income statement based, company A charges company B a management fee. Now, when this happens, you have transactional offsets on both companies. So when company A lends company B money, company A has an asset, company B has a liability. So I have cash that may have gone back and forth. So cash goes from company A to company B. Company B is supposed to pay them back at some point. Company A has an asset, company B has a liability. So when I say that, that means that they're offsetting on the balance sheet. Why is this important? It's important at the time of consolidation because at the end of the day, when it's companies that are owned by the same parent, you don't want to gross up an income statement or a balance sheet because company A has revenue that is derived from company B. For external analysis, you don't want to allow companies to make it look like they've got a huge revenue amount because they're just creating basically ghost revenue and offsetting it with ghost expense. So at the end of the month, all of that needs to be able to balance and go away. That balancing piece is super important. Frequently, excuse me, frequently there are intercompany agreements. So we see that particularly in cases where different companies have different ways of reimbursing sales offices or entities, usually foreign entities with cost plus type arrangements so that they can have a foreign presence because that may be legally required to sell their product in that country or for other just administrative reasons. And so they will have a formal intercompany agreement, but it's not always required. So you'll see it a lot in the United States where you don't have one, but it's one of the commonalities. So what are some of the configuration features in NetSuite to facilitate this? The first one is you want dedicated intercompany accounts. Now that's a dedicated intercompany payable and a dedicated intercompany receivable account. And those accounts should be accounts receivable, accounts payable, account types. That's actually really important. And I'll discuss a little bit, oh, excuse me, in a minute, why that's really important. Intercompany framework is the other feature you want to set up. The intercompany framework has a bunch of stuff under the hood that facilitates booking those intercompany charges so that the system flags them that they're intercompany charges and that they are set up to eliminate. The other thing that you have to set up as a feature is the multiple subsidiary customer. That's because the intercompany framework and the base functionality will automatically set up intercompany customers and intercompany vendors to use for intercompany transactions. Remember that we've set up intercompany accounts that are payable and receivable types. That means that you need an intercompany receivable or intercompany payable vendor or customer, excuse me, in order to process those transactions. So that is very important to set that up. In fact, you cannot finish setting up the features if you don't have that. If you do inventory, you have the ability to automate intercompany management of inventory with automated intercompany drop ships and cross-subsidiary fulfillments. You have to have locations set up to do that, but it is something that enables you to just transfer across at cost without having to worry about actual formal invoicing of your the other subsidiary. Now, you might have to formally invoice depending on certain local requirements. However, there is the ability not to do that. And so that makes it easy to just do transfers across entity lines. So here, this is a little bit of a small slide, and sorry about that. Uh, so I'll go through a little bit. It's a little hard to see. But what you have here is what it looks like when I have created these representing entities. So here, headquarters, their vendor ID is IC headquarters and their customer ID is IC headquarters. So if, for example, France bills something to headquarters, and let's say France creates an invoice to headquarters charging them for something, the customer that they will use is the customer called IC headquarters. And the advantage is now, because they'll have a receivable on their books, they will see that that particular customer has an aging, has transactions available to settle. And in fact, the system treats this like it would any other customer or vendor. And that's really advantageous because you can get agings. And if you have requirements around arm's length, in other words, you need to show that your intercompanies are treated like other non-related parties, you're treating them as you would any other customer or vendor from the standpoint of transactional processes. Of course, even though these are AP and AR, they're not going into the AR trade or AP trade. They're going into the intercompany AP or AR accounts. So this is what you get when you have set everything up right and you tell it to generate representing entities. When you add a new subsidiary, if you have set it up to do so, it will automatically add your new representing entities for the new subsidiary. So it keeps everything up to date for you. The other thing that you have here are the intercompany preferences. So what this enables you to do, again, it's pretty small, but I'll go through it. These are the default accounts. So these are the default intercompany payable and intercompany receivable, intercompany income, intercompany expense accounts. So this enables you to set these up as defaults so that when you do transactions, let's say you do an advanced intercompany journal entry, you've got the ability to hit the I think it's called auto balance, but it automatically puts in the due to due from accounts for you. So my first line can be with company one, debit, whatever account. My second line is company two, credit, whatever account. Then I hit that auto balance button and it fills in the due to due froms. It also flags them to eliminate. Again, really important stuff. So, do we have any questions, Scott?
Yes, we do have one question.
Okay.
And just a reminder, any questions out there, put it in the Q&A button on Zoom. But the question in the chat is, why is it so important to set up intercompany AR and AP accounts as AR and AP account types in NetSuite?
Because first, it tracks these transactions individually as opposed to just tracking the balance. So when you settle your intercompany transactions, you are actually settling individual transactions. Now, if it's in the same currency, it's not so important. If it's in a different currency, when you settle those, you'll have the realized gain and loss that will get booked. Additionally, it permits you to track your OpenAP and OpenAR on your aging so that you can see if your AP and AR due to due froms are starting to get a little long in the tooth. If you want to push to do settlement, it's important to have a process around settlement so that particularly with foreign items, you don't get situations where you're just building foreign exchange exposure. So it permits you to treat the items correctly from an accounting perspective. The second thing it does is it treats it from an arm's length perspective. So it treats your intercompany customers and vendors the same way it would a non-intercompany customer and vendor. This is a requirement for some foreign entities who expect you to treat your intercompany entities at arm's length. So treat them like another customer or vendor. So these are things that when you do it that way, additionally, there's a lot more transparency when you run revaluation at the end of the month for anything that is in a functional or in a currency that's not your functional currency because it revalues each individual transaction as opposed to just the balance.
It makes sense.
So
Keeps it
there's
very clean and automates the process. That makes
makes it easier to balance. Makes it easier to reconcile because you have all the details there. And the system actually, I don't really talk about reporting here, but there's an intercompany reconciliation report feature that comes with the system. But it does rely on that functionality being set up that way.
that is awesome. No more questions right now, Peggy. I'll keep you posted as they come in.
Okay. So what makes intercompany charges different? Um, at a specific entity level. They affect the income statement or the balance sheet. But as I touched on before, On a consolidated level, they do not. Now, that can be a little bit difficult sometimes. I had touched just a minute ago on foreign transactions where you're building up foreign exchange exposure if the balances are getting too high. It also can create concerns just from an entity standpoint around balance sheet items where it may make the balance sheet appear too liability heavy if there's a large liability to a parent company. So, from a metric standpoint, managing intercompanies is important when you understand that, yes, from an accounting standpoint, you are supposed to carry those intercompany balances at the entity level and supposed to report on them, even though that they wash out on a consolidated basis. On a consolidated basis, balance sheet entries as well as income statement where everything's in the same currency are a zero-sum game. In other words, if I have an asset on company A, I have a liability that should be equal and offsetting on company B. At month end, that's one of the exercises that you should be doing is making sure that that really and truly is the case. So, balance sheet, zero-sum game, income statement, items that are purely internally generated. So, internal fees, management fees, cost plus arrangements. They also have a zero-sum effect if the entities are in the same functional currency. If they're in a different functional currency, you get a little bit of noise at the end of the month, but just know to expect it. So how do I determine my configuration needs? So I talked about there's all these configuration pieces in NetSuite. How do I figure out what I need? Number one, where are my subsidiaries located? That is really important because if you have foreign subsidiaries, there are things that are going to be handled potentially differently around the transactions, as well as differently around things translating and revaluing. From a balance sheet perspective, you should still have that zero-sum game. So they should still balance. However, it is important that you know that up front so you know what to expect. And what type of transactions are in play? Is it just going to be the parent charging the child for management fees? For example, it's a way for the parent to repatriate earnings potentially from a revenue generating child company. Bottom up. So the child to the parent. Cost plus, for example, when the child entity does not have a solid or sufficient independent income stream, they will ask the parent to fund them via a cost plus agreement. And then you have lateral. So company A does stuff on behalf of company B. We see this a lot where company A may have a contract with customer A. So company A has to bill customer A, but company B does the work. So company B sends their guys out to do the work for customer A, but that has to be billed by company A. So company B will then charge company A for the services, or company A will give the revenue to company B. So that would be an example of a lateral. What types of transactions generate intercompany entries? Vendor bills. Parent company pays for the corporate tax return, but there are also individual tax returns that need to be prepared. So parent charges all of the entities for a portion of that bill. Customer invoices. So that was the scenario that I just presented. Company A does the billing to customer A, but company B, it's company B's revenue. Inventory transfers. Company A sends inventory to company B because company B has a sales order for that inventory, but they didn't have any in stock. And employee expenses. Employee A is going on a grand tour somewhere. Part of what they're doing is on behalf of the parent. Part of what they're doing is on behalf of company B. So on their expense report, they are expecting to charge part of their expense report to company B because it's company B's expense. And then if you have formal intercompany agreements, if you have those, that's going to drive how you configure things. So if you have a formal intercompany agreement that says that company A will bill company B for cost plus 5%, you know to set it up to where there's some sort of invoicing agreement or calculation methodology that calculates how much should be happening there.
Peggy, we have a couple questions that
Yes,
trickled through.
sure.
First one is essentially what is the process for when we need to bill another company for shared services? For
Mhm,
example, we receive a $1,000 invoice from Charted that
mhm,
needs to be allocated to USA for $800 and
mhm.
Mexico for $200.
So there are a couple of ways to do that in the transaction. You have the line item distribution in NetSuite. That is a suite app that you would need to download and configure. There are also third-party products, notably NetGain Shared Transaction, that permit you to do the same thing. So you are able to distribute at the line level. You'd end up having two lines. So line one is going to be to entity A for $800 to phone expense or whatever it was. And then line B will be to the Mexican entity for $200 for phone expense. And then it will create the transactions under the hood so that you would actually go and see the allocation and see where it takes everything out. So at the end of the day, it's going to be on the parent company, it's going to end up being AP for the full amount with expense 800 to the parent, 200 to the Mexican entity with the appropriate receivable, intercompany receivable AR on the parent, intercompany payable on Mexico. Oh, sorry, long answer. What's the next question?
Next question is it's prefaced with it might be early, might have gone over it, but how do you offset AR and AP to net them to make payments if using invoicing through AR and AP?
So, okay, what you can do, I'll talk about intercompany netting right down here on number 3. So let me get to that, and I'll talk about intercompany balance settlement processes in number 2, configuration needs. So first, what is the originating currency for intercompany transactions? You need to know, you need to decide, pick a currency because the last thing you want to do is have company A bill in euros and company B book it natively in US dollars. You always want the base currency of the transaction to be the same on all books. So, how do I settle my intercompany balances? So, what you should be doing is settling these on a monthly or quarterly basis. The reason for that is you don't want to build up intercompany balances because A, they can gross up your individual income statement or balance sheet. And B, if they're foreign, they create excess exposure. So you want to avoid that as much as possible. Uh, in some cases, particularly with foreign entities, you might have balance sheet requirements to where you can't have certain ratios that are more than X. And having excess liability, even if it's intercompany, will throw off those ratios because they look at your capitalization and it could trigger issues around capitalization thresholds. Uh, so you want to have something in place to do that. Obviously, because these are treated as AP and AR accounts, You can easily see at any given point the detail of what you have and choose those for payment. Intercompany netting is what happens. It's a process that you can do in NetSuite. All it does is it nets an intercompany AP and an intercompany AR balance for the same entities. So I'm company A. I have a receivable of $1,000 from company B. I have a payable of $500 to company B. When I run intercompany netting at the end of the month, it's going to look at that and go, okay, you have a receivable from company B of 1,000, a payable to company B of 500. I'm going to net those. I'm going to apply the payables against the receivable balances. So I'm going to clear those entries just chronologically, and I'm going to have left over $500 as a receivable. So that's what it keeps as the leftover after intercompany netting. And it does that on both sides. So it does it for company A and it does it for company B. Because remember, company B is going to have a payable of $500 left over at the end of the process.
I get a few more questions on netting. Can you comment on any ways to ensure netting is done by segment? For example, you want to net AR and AP balances that have the same class tag to them.
No, that was a fast question. No, it does it by the total balance. It's not going to do it by segments. It's going to do it by entity. So,
Another
unfortunately.
question here is you referenced a third party add-on before
Yeah.
that allows line items to go to
Mhm.
different entities. What was
Mhm.
that called?
It's net gain shared transactions. Um, it also it does allocations intra as well. It also permits you to line item on things like customer invoices, which is great for for when you have arm's length transactions or you have shared revenue transactions, like I talked about before. It also does have a feature that if you do an intercompany invoice for the purposes of arm's length, which happens to be the next item, it will automatically create the vendor bill on the other side, which is kind of slick because otherwise you have to process it. And I'll talk about that in a minute when we talk about how to do these. And there's some other ways to work through it using AP automation tools. So, arm's length transactions. Why ever would I want to do all of this rigmarole of creating an invoice and creating a vendor bill when I could just do an intercompany journal entry? Why would I do that? Well, if you're overseas, because the tax people say so. And what they say goes. So, just a word of warning, in most foreign locations, they require arm's length transaction. That means if parent A is billing subsidiary B that is located in Belgium, parent A needs to send them an invoice. Company subsidiary in Belgium needs to create it as a vendor bill. This is not optional. They will get very mad at you. Don't let them get mad at you. It's unfortunate. So, this is something that is very, very common. Um, Sometimes there's a preference with Canada, but I don't believe it's actually um, statutorily based. Double check, your mileage might vary. It also might be delineated in any intercompany agreements that you have created that you have to do it this way. So read your documentation. See what you agreed if you did intercompany transaction or intercompany agreements. Additionally, if you have intercompany investments or long-term debt instruments, understand how those should be booked because, particularly if they're foreign, the accounting for them may not be the same as for the intercompany AP and intercompany AR because they may be treated for consolidation as translating at historical. They may not revalue because they wouldn't be considered monetary assets. So determining your configuration needs is really important so that you know how to set up the base accounts. You know how to set up, is it an AP or AR type account? Is it an investment type account? Do I need to worry about intercompany billing? Am I going to do intercompany netting? Do I have arm's length transaction requirements? So you need to look at what all of your intercompany transactions are going to look like. And then that's how it determines your configuration needs.
Peggy, we've got some more questions in here. So
Dang, everybody's
um,
listening.
some examples, but let me go through these. Regarding intercompany settlement, what if
Mhm.
one of the parties doesn't have enough cash to settle their balance?
Ah, so what ends up happening at that point if they are never going to create enough cash? You sit down with your tax people and see if you want to turn that into an investment. That is how that is commonly handled. Yes, that's a real issue. And normally that doesn't really get looked at, particularly for foreign entities, until they've got an intercompany balance that is at a point where the monthly FX is so painful that it has triggered a response.
Two more questions. One is, can I have an invoice from company A for inventory items to
Mhm.
company B as an expense and not an inventory transfer?
Yeah, but you're going to have to do multiple documents to do it. You can't do it as an inventory transfer. However, you can create an invoice that will transfer it out of inventory on company A. And then when you receive that vendor bill, company B, at that point you charge it. But you would do it as an inventory, as you would bill. Okay, so anyway, you would credit inventory, debit intercompany receivable on the parent company, on the child company, credit intercompany payable, debit expense, debit cost of sales or whatever, wherever you're trying to send it to, or supplies or what have you. Next.
Last, last question showing up is on the intercompany netting front.
Mhm.
How does NetSuite handle multiple currencies between the two counterparties?
So if the currencies match, it matches those. So the currency, remember, it's at the transactional level that you're doing this. So it is going to try to net them against those currencies. If the currencies don't match, it can't net them.
Mm, the ex-
It is it's a downside because it doesn't have anything. You cannot match something. You cannot apply a document against another document if the documents are in different currency. So
yeah,
no, it will not match those.
yeah, and that was the second part of the question. Will it just net the one currency, or can it net, you know, one of the
No, so
currencies
it
against
will
both?
net, let's say there are dollar amounts and there are euro amounts.
Yep.
It'll net the dollars against the dollars, the euros against the euros, um, but it will not net euros against dollars.
Okay.
Okay.
Another one came in, Peggy. Piggybacking on the not enough cash topic,
Mhm.
what if company A does not have a bank account and or cash, but company B wants to pay it on their behalf? Is there a way to transfer company A balance to company B to pay, or do you have to create invoices to move it?
Okay, so you're doing centralized AP, basically, potentially. So, so
I don't know the
that's
exact
a
use case here,
yeah, that
but
would be the use case I would see. So company A, and I see this a lot actually. So company A doesn't have a bank account. Um, excuse me. What a lot of people do offset wise in a case like that is do some sort of create a management fee to start offsetting some of that stuff. So, we pay all these bills on your behalf, but you're doing a service for us, so you're going to charge us, so you're going to have a receivable that's going to offset the payable, and then you net them. So that's how a lot of of companies will try to do something like that. And that way you work around it with no bank account. So it's something to consider. So,
Another one, Peggy. I got another question for you.
dang. Okay.
Can you net AR and AP balances against due to slash from balances?
New. That's one of the reasons you want them as AP and AR types. You can only net them if they are AP and AR account types. You cannot net other current assets and other current liabilities using the intercompany netting feature. You would have to manually do it with journal entries. Okay. So, talking about intercompany transaction types, what ends up where? Intercompany AP and AR. Cross-charging of third-party expenses. That is going to end up in that intercompany AP and intercompany AR, which are AP and AR, other current, well, not other current assets, but, by definition, a current asset, a monetary account, current asset or current liability, monetary accounts, both of those subject to revaluation. Cross-charging of employee expenses. Again, uh, company A, their employee does stuff for company B. Again, intercompany AP or AR. Uh, Allocating revenue to entities performing the work. Intercompany revenue or expense items such as management fees or cost plus arrangements. Transfer of inventory between entities. Again, these are all monetary type transactions. Intercompany netting is going to go in those AP and AR. Now, you've also got, of course, your investment subsidiaries and long-term debt potentially. So those need their own accounts with appropriate, investment subsidiary, frequently long-term asset. The flip side is going to be in the equity section of that receiving entity, unless it's structured as a long-term debt instrument between both parties. Normally, long-term debt instruments do have actual formal written agreements. Auditors like to see that. So if you're going to have those types of instruments, they should be written up as a general rule. Not everybody does. However, it is just a better audit piece of thing. And then, of course, settlement of intercompany transactions generally goes through cash. Uh, Uniquely, if it is converting those into investment subsidiary or some sort of long-term debt instrument, that would be done via a journal entry, but generally that would be done by some manner of disbursement. It could be done potentially via an intercompany or via some sort of a wire transfer dispersing out of one entity. Um, so the third party product permits you to actually do all of the ins and outs, including the intercompany piece, on those types of transactions. So worth knowing. And that way you can apply those to the correct charges on the paying side and on the receiving side so that you can relieve your payable and receivables.
Okay, we have a follow-up question to
Yes.
the netting of AR AP balances against
Mhm.
due to slash from balances. And the follow-up
Yeah.
is, can an AR slash AP be created using the due to slash from GL to force the elimination?
I'm not totally sure what. Can you read that to me again? I want to make sure I interpret that question correctly.
Yes. Can an AR slash AP be created using the due to slash from GL to force
Yeah,
the elimination?
yes, you could. So let's say you've got it sitting in an intercompany, a due to do from somewhere because it just was there. And now it really needs to be in that AP or AR account so that it will eliminate. Yes, you can do an entry to move those. There are some tricks to doing it that I don't want to get into, but you're moving it basically from theoretically a non-eliminating account to an eliminating account. So keep in mind that when you set up an account, you can designate whether or not it's going to eliminate. And if it eliminates, you need to have all of the information on every single entry with the representing entity. So, who's the customer or vendor? What's the entity that it's between? You mark the line to eliminate. There's a bunch of pieces there. The advantage with using the representing entities, even if you're doing it in a journal entry, is it fills in all the other rubbish for you. So you don't have to think about it too hard. Otherwise, I don't know if anybody's ever tried doing an advanced intercompany journal entry. There's a bunch of pieces that have to be there. And if you miss one, it rejects it and you have to start over, and it's very frustrating.
We've got another question here, Peggy.
Yeah.
Can I have an invoice from company A for inventory items to
Mm-hmm.
company B
Mm-hmm.
as an expense and not inventory transfer?
Yeah. Just I think we talked about that one before.
Yes,
So
we did.
company A, I'm going to create an invoice for inventory items. So I'm going to relieve my inventory. Company B is going to receive it as a vendor bill. Company B doesn't look at company A's. Company A thought it was inventory. Company B is like, nah, it's not inventory for us. It doesn't qualify as inventory. So I'm just going to expense everything. And that's perfectly fine. Because company B is saying, it's an expense. I'm using it for internal purposes. So I'm writing it off as demo supplies, cost of goods sold, whatever. So yes, you can do that. Um, so inter intercompany.
Okay, what is the correct process of doing it?
Uh, well, what I would do if it were me is I would, because I cannot relieve inventory with a JE. So that means I must do an invoice and fulfill it to take it away out of my inventory on company A. Company B, I process it as an AP voucher. So I process it as a vendor bill. And that way I can put it wherever I want. So obviously, if you're doing that, here, for example, cross-charging of third-party bills between entities that doesn't require arm's length, so I don't have to rebill it. Um, I can, what can happen is I can either do a vendor bill or here, if I'm allocating revenue to entity or I'm charging for inventory or what have you. So let's kind of break down these different, because I've got transfer of inventory here, and I didn't actually talk about doing it to where it's not treated as inventory on the receiving end. But I'll talk about that in a minute. Let's talk about how to do cross-charging of stuff. So I've got, again, that legal bill that I was talking about. I'm sending half of it to my entity in, I've got an entity in New York. Uh, I've got an entity in I don't know, Pittsburgh. I'm going to split that and it's going to be on a line item basis on my invoice and split 50-50. Now, what I can do is I can set this up, for example. Additionally, there are ways to set it up to where it can be now, not with native NetSuite, but with shared transactions from NetGain, I can do centralized AP as well, which is another way, so doing cross-charging, what I would do, I'm entity B, I do not have a bank account, but I control my purchasing. But company A pays it for everybody. So I put in my invoice and I make it it's a payable now on my end. It's an expense, debit expense, credit, intercompany payable. And then company A, who pays for everybody, is going to pick up what I put in on my entity, but it's going to pick up that vendor payable and then pay the vendor. So where do I see this a lot? I see it in real estate management companies. So places that do things like the WeWork model. The individual locations may not pay their own bills. Everything comes out of parent who manages all the properties. But they still manage their own purchasing because they purchase the snacks for their location. So they get the bill from the vendor for their snacks. So they put in the bill for their snacks, but then parent pays it. Uh, Cross-charging of employee expense reports. Again, you can do this. You do these, treat them as that transaction type, and then allocate the line items. Um, Again, allocation of revenue for entities performing work but not necessarily billing the customer. Again, the billing entity on a line item basis should be allocating its revenue back to who it belongs to. Now, they still have the AR, and theoretically, at some point, they're probably going to want to remit the funds they collect back to the company that performed the work because it costs company, that company money to perform the work. They have to pay people and things like that. However, the cash is going to come into the entity that did the billing, but that doesn't mean that the revenue has to stay on their books. So you're going to allocate out that revenue. Uh, Here for revenue and expense items where you don't require arm's length transactions, do it as a journal entry at the end of the month. If it's an arm's length transaction, you are going to do an invoice and create it as a vendor bill. Again, that can be automated one of two ways for the vendor bill. You can do it with a third party if you don't have an AP automation tool or your AP automation tool is only set up for your primary subsidiary. Or you treat it as a vendor bill with your AP automation tool, such as Charted. Had to put in the plug. Uh, So you treat it with your AP automation tool. You send out that customer invoice to whatever that AP at blah, blah, blah email is. The AP automation tool will pick that up. We'll treat it appropriately based on it being to the representing entity vendor. Again, another reason why it's so important to set that up as intercompany AP, intercompany AR, set up your representing entities because those are your customers and vendors for doing those. So, um, and again, intercompany transaction for arm's length, you can use basic functionality of intercompany PO, intercompany sales order. That is one way to do it. Of course, that doesn't handle the scenario presented before where they're expensing it on the receiving side. So do keep that in mind. But if it's a straight inventory transfer, you can do intercompany POs, intercompany sales orders. You can do the intercompany transfer. Intercompany PO and intercompany SO allows you to do markups. That's a difference. Now, so that should not say RSM shared bundle. That should say NetGain shared bundle. I apologize for that. That is incorrect. Oh, NetGain, sorry, NetGain or RSM. RSM does have a shared transaction bundle as well. My apologies. So there are third-party products out there. NetGain, RSM. There's the native NetSuite. I will be honest and say that the native NetSuite is not as intuitive or user-friendly. Nothing against NetSuite. If there are NetSuite people in the room, I'm sorry. I do apologize. However, it's you can do it if your intercompanies are fairly straightforward. Certainly, the line item distribution is an option. Uh, so let's see. Here, intercompany investment subsidiaries and intercompany long-term debt, those are journal entries. They can be handled with intercompany journal entries. Settlement handled with intercompany journal entries, with representing entities, and then you apply the payments. If you do it with an intercompany journal entry, you have to go in and manually apply the payment afterwards. So keep that in mind. Any other questions we want to talk before we get into foreign exchange?
Hey, no, there's no more questions. We appreciate the candor and honesty about what's what's good, what's not so good with NetSuite. This is for practitioners again, so
Yes.
let's keep it going.
Yeah. Okay. So, intercompany charges. This one is really important. Intercompany charges with entities with different functional currencies should be booked in the same currency on both entities. So, if I'm company A and I charge company B $5,000, company B should not settle that as 4,000 euros. Don't do that. They should also not book it natively as 4,000 euros. They should book it as 5,000 US dollars and let the system translate it to be 4,000 euros. That's important because if you book it incorrectly, now on the foreign entity side, it views it as 4,000 euros. If you have booked it natively as 4,000 euros, it will not revalue your 4,000 euros. And at month end, when you do your reporting, you will be out of balance on your intercompanies. Because company A will show that they have a receivable of $5,000. Company B will show that they have a payable of $4,972.12. And that's because it didn't revalue at the end of the month. So you do not want to do that. Another reason, so this, I had a client once upon a time who was settling in a different currency than it was originally billed in. So their intercompany had about $200,000 in it, but the amount that was being revalued was in the millions because they had settled in a different currency than the initial charge was in. And so there was no way to match those up. So the system looked at it and said, well, you still have a receivable of 5 million pounds, even though it's been being paid in dollars. So never settle in a different currency because it will create all. NetSuite is not capable of handling it. There are other softwares that are capable of handling it, but NetSuite is not one of them. So you need to settle, you need to pay stuff in the same currency that the original invoice was set in. And that applies across the board with AP and AR. So you don't want to send a customer, an outside customer, an invoice in dollars and have them pay you in euros because the system can't effectively handle it. You have to do a bunch of workarounds. So you want to avoid that whenever possible. When an intercompany AP or AR balance is denominated in a currency that is not the functional currency of the entity, it is subject to revaluation. You can double check ASC 830 all you want. It views those as monetary assets and it says you should revalue. And that can get ugly because the P&L on that goes below the line on your income statement. And so if you aren't effectively managing those, they can start to get a little ugly. So again, that's where you want to keep an eye out on those types of issues. And you want to absolutely manage those balances as much as you can. And if they start getting out of control, you talk to your tax people and start looking at converting them into some other type of instrument or balance sheet item. Last, many countries require intercompany charges to be at arm's length. I've talked about this before. Again, tax authorities are very unbending and they consider this to be non-optional. That also can mean that if you're doing a charge off of shared expenses, what you frequently will have to do is collect those in an unbilled intercompany account and then bill them out at the end of the month on a formal, pretty piece of paper. So it can complicate things. So for arm's length transactions, understand for foreign entities what that really means. Because you may have to do some different processes than you would with your US based entities. So,
Peggy,
yeah.
Peggy, we have a question.
Mhm.
Within NetSuite, what report do you download to ensure that all these transactions balance? For instance, I want to trace the amounts in AP from company A for company B, with the AR amount in AR company B for company A, and with other subs. So how do you?
There is an intercompany reconciliation report that helps it a lot. What I normally do for that process is, and I've also created some just items, account reports. So, balance sheet detail report, adding back in the currency label and the foreign currency amount. So that way, when you run a balance detail and you run it consolidated, you can see all of the ins and outs in the base currency. So I use that to help me when I have to research. But my starting point is going to be that intercompany reconciliation. Again, it relies on you having AP and AR account types.
Got to have the ARAP account types. We got one more question,
Yes.
Peggy.
Uh-huh.
The disclaimer is I know it's out of scope, but is there a way to automate the clearing of the intercompany reconciliation?
Uh, yes. Uh, third party. So, strongly advocate, again, you know, uh, that wasn't, I didn't mention those as part of doing reconciliations, but if there are a number of great products out there, NetGain has their net close product, Flowcast has a product, Blackline has a product. There are great reconciliation tools out there that will permit you to do those reconciliations on a consolidated basis and match those transactions. So if you have a lot of this and it's taking a lot of time for efficiency purposes, I would advocate that you take a look at some of those automated reconciliation products to streamline your reconciliations. We are like
Fantastic.
right at time.
Right at time. There's no more questions. So we'll wrap it up here. I just want to say, Peggy, thank you so much for going through all the detail here. It was incredible. Thank you everybody for joining today's webinar. We really appreciate all the questions, all the interaction. Please reach out to us directly with any other questions on Intercompany. We're here to help as a full service NetSuite provider. So thank you very much, everybody, and have a great rest of your Tuesday.
Thanks,
Take care.
everyone, and I'm always happy to answer questions.